Today we're going to talk about how investment managers can take one of the safest asset classes, which is bonds, and magnify those returns to get a significant rate of return on your investment. These are called credit investments, and we currently have two of them in your portfolios. So it all starts with a bond. And when you buy a bond, you're essentially lending money to a company or a government. And what they promise to do is they promise to pay you back the initial money you lended plus a specified rate of interest. And the biggest risk when you're investing in a bond is default. So that means a company or government essentially goes bankrupt and can't pay you your principal or interest back. So when you're investing in a government, the risk of that is very, very low. And because the risk is low, they typically give you a lower rate of return when you lend them money. And when you invest with a public company, they have a slightly higher likelihood of going bankrupt. So they give you a slightly higher rate of return on your money. So for example, if you bought a bond from Rogers for 1 year, let's say they were going to give you a 2% return. So you invest $100. At the end of the year, they're going to give you your 2% return plus your $100. So you get $100 plus the $2 at the end of the year. If you're investing in something safer, like a 1-year Government of Canada bond, they give you, let's say, 0.5%. So you invest your 100, you get the 0.5%, which is 50 cents at the end of the year. So you have $100.50 at the end of the year. So what private credit does is it isolates the difference between these two returns, so 1.5%. And earning 1.5% isn't all that exciting. $100 at 1.5% is $1.50 profit at the end of the year. So what they do is they use leverage to increase the amount they're investing for you. So they take your $100, they leverage it by 5 times, so they'll invest $500 for your $100. And now when you invest $500 at 1.5%, you get $7.50 or a 7.5% return. So now that's a little bit more appealing. And there is a slight cost for borrowing here. So instead of 7.5% return, the return might be closer to 7%, but still it's a very attractive return for investing in a relatively low volatility asset class. Now, there are some more intricacies to exactly how this works, but at a high level, you're buying a safer asset class and using leverage to magnify those returns. And if you have any questions at all about the details and further intricacies about how that works, please give us a call. We're happy to talk in more detail about those two investments in your account. And again, we currently have the capacity to take on new clients. So if you have a friend or a family member who might be interested in these types of strategies that have low volatility, aren't very correlated to the public stock markets, then please pass this video on to them and we're happy to take their call. Thanks for tuning in, and we'll follow up with you again very soon.